Hi all, and welcome to this advanced video financial modeling training course. In this course we're going to look at a complex greenfield toll road model. Okay, so let's jump into it. Okay, a few housekeeping duties before we start. Obviously this document is subject to Video Financial Modeling's standard terms and conditions, which you can find on our website. In addition to these standard terms and conditions, this document may not be reproduced in whole or in part, nor may any information be divulged or disclosed to a third party without the prior written consent of Video Financial Modeling or as required by law. And this document is provided for learning purposes only, and Video Financial Modeling and its directors, employees, agents and representatives make no representation or warranty about the accuracy or completeness of information contained in this document. Okay, so what will you learn in this course? By the end of this training course, you should understand the characteristics of infrastructure assets, understand why project finance is used to fund infrastructure assets, have a reasonable understanding of financial concepts such as cash flow available for debt service or CFADs, debt service coverage ratios or DSCRs, debt service reserve accounts, depreciation, replacement capital expenditure sinking funds, and a few other things that we're going to look at. You should also be able to apply a large range of key modeling concepts, and these are best practice modeling concepts to simplify tasks. And you should understand the typical project finance structures and also the parties related to those structures and the key components of project finance modeling. So when we talk about key components of project finance modeling and setting up the financial model, we'll look at everything from the assumptions sheets down to the cash flow waterfall. And by the end of this tutorial, we're going to look at a case study which will take a couple of days or maybe a bit longer than that, but you should be able to build a complex financial model to find a greenfield toll roads toll structure. Okay, so let's jump into it. The first thing we're going to look at is we're going to look at an introduction to infrastructure and project finance. So this is for all the people that aren't too familiar with infrastructure and project finance. If you are, then you can sort of gloss over or fast forward the tape. Okay, so let's look at this. So what are the characteristics of infrastructure? Before we look at the characteristics, you must understand that infrastructure is considered to be the foundation of a country's economy. Roads, airports, sewage treatment plants, electricity transmission lines, things like that, they are core assets that are required by any economy if they want to grow. Now, the characteristics of infrastructure, I've only listed a few here, or we've only listed a few here. But one, they usually have significant barriers to entry. So usually the service provider has a monopoly over the industry. So you can think of your local electricity provider. Two, they usually have stable, predictable throughput or cash flows. So say for example, an electricity provider, going back to that example, they would be able to pretty accurately forecast how much demand they'd have for electricity over the coming 12 months. And this is particularly applicable in a large economy that's already developed. So you talk about the US, the UK, etc., etc. In emerging economies, it's harder to forecast your throughput or cash flows unless it's an availability based cash flow. So usually, the third thing is usually infrastructure assets have a long economic life. The fourth thing is their long-term growth is usually correlated with GDP and or inflation. So say for example, if we look at a toll road, which we are going to look into a bit later in our case study, as our economy grows, more cars are going to be on the road, more trucks are going to be on the road, so our long-term growth of revenues or cash flows is going to be correlated with that growth in GDP or activity. Now, I've just got a quote from Barack Obama, and what it says is, it says, in an attempt to kickstart the US economy, Barack Obama said, we're going to rebuild 150,000 miles of our roads. That's enough to circle the world 6 times. So obviously, the President of the United States understands that infrastructure is a catalyst to economic growth. So now, why project finance, PFIs or PPPs? We'll look at two parties here. We'll look at both the government or the concession grantor in most cases, and also the sponsors and equity holders. And we'll also look at mutual benefits for both of these parties. Okay, so from a government point of view, the government gets to essentially finance these assets through a PPP or PFI, where they spread the finance of projects over the infrastructure asset's life. So instead of funding the project themselves, they'll tender it out to the private sector who will fund it and also get obviously the rewards or the revenues from that project. Okay, so it's utilized by the government, one, as a form of funding, or the second reason that the government that benefits the government or concession grantor is that it attracts foreign investment and technology. So think of things like trains, high-speed trains, etc., etc. You want to attract foreign investment and foreign technology. Maybe the Japanese are providing better technology in the rail transport sector. So if you attract those guys by offering them foreign investment and also the potential to build and operate these types of assets, then that might be attractive to a foreign company. The third thing is it utilizes experienced external management resources. So the government doesn't have management resources or sufficient management resources in most cases to manage an infrastructure project. So what they do is they often tender out or privatize these assets so that they can get the people that know infrastructure assets best to come in and run these assets or build these assets. Okay, from a sponsors or equity holders point of view, usually the sponsors insulate themselves from the risk of project failure. So what usually happens is an SPV is set up separate to the company, debt is put into the SPV to fund the project, debt and equity combined. But what happens if the project goes belly up, then there's no recourse to the sponsor's balance sheet. So this is quite handy when trying to separate the company's core operations to the project's operations. Okay, and the second point sort of relates to the first point, is corporate level borrowing covenants usually don't constrain sponsors' ability to raise debt for the project. So what happens in this SPV is the revenues and expenses or the cash flows are ring fenced in the SPV and they're used to repay the debt and equity, and borrowing covenants at the corporate level don't restrict the borrowing at the SPV level. And the final thing is a mutual benefit to both parties is risks and rewards are passed to the party that can best control them with a view to greater efficiency. Okay, so obviously if one party understands a component of the project better than another, then they're usually going to be able to price it more cheaply than the other. So you're getting cost efficiency out of that, but also you're getting things like technology, which we mentioned before. So you're getting gains from technology that you might not have utilized if it was a pure engineer, procure and construct or a DBO sort of thing. Okay, so for more information, you can have a look at Denton Wiles Sapp's Guide to Project Finance. I've provided the link below. This is a great Project Finance 101 guide. It contains heaps of useful information about project finance. Okay, so now let's look at some key financial concepts that pop up in every project finance deal. So the first one is CFADS. We've got a simple definition of cash flow available for debt service, and that is revenue minus expenses minus maintenance capital expenditure minus tax plus or minus movements in working capital. We've got a simple example here. It says an example of CFADS is calculated below. So we've got revenue of 100, expenses of 50, and this could be any units, it could be US dollars, it could be Australian dollars, etc., etc. We've got maintenance capital expenditure of $10 or negative $10 because we're expending it. We've got tax of 9, and we've got working capital movements of $1 or negative $1. So if we aggregate those cash flows or net out those cash flows, we come to a CFADS of $30. So what does this say? This says how much cash is available for all our financing. But firstly, obviously debt, because that is senior to any equity instruments. Okay, over on the left it says these are the cash flows usually required to maintain, not grow the current business. Now this is usually the case. So it says essentially they are non-discretionary expenditure items. Now, video financial modeling has seen this done a number of ways, and we've got a footnote here, but it says that CFADS may also include replacement CapEx, which is probably discretionary to a certain point. So CFADS will always be defined in the project loan documentation, so always look in things like the facilities agreement, or sometimes they're called credit agreements, etc., etc., to find out what the actual definition of CFADS is. Okay, and don't worry if you don't get all this the first time. When we're actually building the complex Greenfield toll road model, we will go through this CFADS in detail, and it will be drummed into you. So now we're going to look at working capital. So what is working capital? So working capital arises because of timing differences between accruals and cash payments. Say for example, you are due to get a payment of $50. What you would do is you would usually book that $50, so it would go in your income statement as a revenue. But depending on when the timing of cash flow comes in, so you might be due that $50, but you might not have been paid that $50. This is what we're talking about when we're talking about working capital. So let's have a quick look at an example of an accounts receivable accrual. And in this example, there are 30 days in each of these periods, and debtor days are 30 days. So debtor days are simply your accounts receivable days. I think it's probably best if we do an example. So what we can do is, let's go, I've just got a workbook up here. Now, you don't need to follow along here, so I'm just going to put debtor days example. Now I'm going to do a period, so 0, I think it goes up to 3 or 4, 3, and then I'm going to have my revenues, so accruals, debtor balance, movements in debtor balance, and revenue paid. Okay, so firstly I'm going to put in some numbers here. So these are the revenues that, so 60, 70, and I think the last one was 80. Yep. Okay. Now our days, as we said in the example, now I'm just going to put in a pointer option. So as we said, the debtor days are 30 days, and also there's 30 days in each period. Okay, so let's just go days in period as well. Just going to go 30. I'm just going to copy that one quickly across. And now let's just have a look at the formula here. So what we've got here is we've got, let's just change that back to an arrow. We've got revenues accruals times the debtor days divided by the days in the period. So let's put in the formula and then we'll talk a bit about it in a second. So we got equals revenue times, and our debtor days is 30. I'm going to hard code it in the actual cell. You shouldn't usually do this, but let's do it for the purposes of this example. Then divided by this. Okay. So now we're going to find intuitively that you see these numbers here. So our debtor balance, right, if we've got 30 days in a period, and we've also got debtor days of 30 days, so between the time that we accrue the revenue and the time it's actually paid, we know that our debtor or our accounts receivable balance is going to be exactly the same as the revenues that come in that period. So if we've got a revenue accrual at the very start of that period of 60, then we're going to have a debtor balance of 60 as well, because we haven't been paid in cash yet. So now if we look at our movements, we go equals, so that minus that, and as you can imagine, let's just copy that one across. Our revenue paid in the first period is going to be 0. So that equals the sum of that and that. Okay, in the next period, what's going to happen is, okay, so our $60 that we accrued in the first period and we weren't paid is going to pop out. The same thing with this one. So in the second period, the 70 that we accrued but we weren't paid is going to pop out. Okay. So let's go back and let's go to the next one. We'll talk about, and we're going to do detailed examples of debtors later in the complex financial model. So don't worry if you don't catch all that there. We're going to do it again, and we're also going to do it for creditors as well. So on the accounts payable side of things. So depreciation. So in this complex financial model, we're going to assume that the tax and the book depreciation are the same. So what's going to happen there is we're not going to get any timing differences. So we're not going to get any deferred tax assets or deferred tax liabilities. In our other training courses, we're going to look at that concept, but for this first one, we're not going to look at that concept. Okay, so what does depreciation mean first of all? So the accounting concept which aims to allocate the cost of assets to periods which the asset is used. So we're trying to match our revenues from our assets with our expenses from the assets. So sometimes people say that straight line depreciation is not the best depreciation method because it's not matching your revenues for that asset with your expenses. Say for example, if you got an asset and in the first 2 years it had a lot of revenues, then you'd probably be better off using a depreciation method which depreciates a large amount of that asset at the start, So the first 2 years, and then thereafter a smaller portion of the asset. That's a bit of an aside. Let's just look at a quick example of how depreciation works, in particular how straight depreciation works. So here we've got, you buy a machine for $60 at t equals 0. The machine has a life of 3 years and uses straight line depreciation. Okay, so what we're going to do is we're going to do an example of this. So like I said before, you don't need to follow along in this example, just try and absorb as much as possible. And we're going to be doing this stuff over and over again, so by the end of it, you should understand the whole lot. So let's go. We're going to use a corkscrew account, which we will talk about a bit later. And we're going to put in new assets and depreciation. Okay, and I think, yeah, we can use the same periods as here. So I'm just going to copy those ones. Okay. Now we're going to put in the opening balance. So the opening balance is simply the closing balance of the previous period, and this, we'll talk about this a bit later, but this is just a basic corkscrew account. Okay, so now our assets, so let's put that one across there as well. Just going to format this a tiny bit. Our assets we said were $60 at time equals 0. So now what you'll see is our closing balance, because we've got new assets in, is $60. And then subject to any depreciation, our closing balance would change. So now if we're using a straight line depreciation method, we said it was going to be over a time of 3 years. Let's do this one a bit. So depreciation periods, and then we can go 3. So what we can do here is we can go equals. We know it's going to be fully depreciated after 3 years, so equals, and the new assets. Now this isn't the best way to do it, because what you usually do is take a sum of the new assets, but for this purpose it's a simple example, so let's just go F4 and then divide it by that one. So let's absolute cell reference again, so F4 to absolute cell reference. Now that gives you 20. We want a negative 20, so we're just going to put negative in front of that. And what we should see if we copy across, so Control R, is that by the end of the third period we should have 0 closing balance. So that asset is fully depreciated there. So this closing balance is pretty important as well. Like our depreciation, that obviously runs through our income statement, but our closing balance, that runs through our balance sheet in most cases. Now, in other project financings where you've got a guaranteed availability payment, there is a new financial concept called IFRIC 12, and this is accounting for concessions, and they do not depreciate the asset as such. They use a different methodology, but we're not going to go into that right now. So let's go back to the sheet, and as we said before, there are a number of different depreciation methods, including straight line, double declining, etc., etc. Okay, so now let's look at a replacement capital expenditure sinking fund. So a sinking fund reserves money for replacement capital expenditure. And as we say at the bottom of this slide, we'll just jump around a bit here. A sinking fund reserve aims to smooth cash flows by reserving cash for lumpy capital expenditure. So if you think of, say for example, a toll road, every 5 to 10 years they have to resurface that toll road, and there's a large capital expenditure related to that replacement or resurfacing. So what happens is there'll be a large cash requirement. Now, The cash requirement can be funded many different ways. I mean, you could fund it with debt, sub-debt, equity instruments, etc., etc. But one way to do it, and it's probably not the most efficient way, but it is done in a lot of project finance situations, is to reserve a portion of your cash flow or reserve an amount for a number of years prior to that replacement capital expenditure. So there are a lot of ways to do a replacement capital expenditure sinking fund. In this training course, we're going to look at a very, very simple way, which is retaining for a number of periods prior to that replacement capital expenditure. Here's a quick example. So it says, an example of how a sinking fund works is shown below. You know that you have to replace a machine for US dollars 80 in 4 years' time and want to reserve money for it over a 4-year period leading up to the purchase. Let's go back to the Excel spreadsheet. Okay, now I'm going to do a sinking fund example. So it's just sinking fund will do. Well, this has got 4 periods, so I'm just going to change this to 1 equals that plus 1. Okay, so there are our 4 periods. We've got an opening balance, a closing balance. So you should be getting a feel for what a corkscrew account is as we go along, but we will explain it in detail shortly. So let's go equals that, and this one now equals that. Okay, and what we're going to do is replacement capex. So this is the expenditure. We know the expenditure is going to be negative 80 at t equals 4. Okay, so sorry, this one didn't sum up properly. Okay, that's right. And we know that cash, let's call it cash reserved. I might have called it something different. Money retained, cash reserved, same thing. So we know that we're going to have to get $80 in 4 years' time. So what can we do to get that $80? Well, we know that amount, so that's a fixed amount as well. And we know that it's over 4 years. So let's just go like this. So if we go that amount divided by 4 years, we're going to have to lock that cell. Now this is a bit scrappy in terms of financial modeling, but all I want to point out here is the actual financial concept related to a sinking fund. So now what happens is across those 40 years, okay, so now look what's happened. We've reserved $20 per period, and we've been able to pay out that $80 in replacement capex, and our sinking fund is drained at that point in time. Okay? So simple concept. I mean, you can think of it as the reverse of depreciation, right? So the depreciation was over a 3-year period and it cost us $20, or the expense was $20. And this one, instead of, we know the expense, now we're trying to find out how much we reserve for it.